Hey everyone, I am David Vasquez. Today we are joined by a longtime friend, Alex Carballo. Alex is a CPA and tax strategist. He used to work for one of the big four companies, Deloitte.
Yep. So our firm specifically specializes in high net worth foreign families, high net worth domestic families, but helping them navigate kind of the compliance and a lot of the regulatory kind of landscape.
Yep.
From an investing standpoint here in the United States.
Yep.
Imagine if we were to go to China or one of these countries and try to invest in real estate, we won't know what's going on. So where we come in is we kind of represent these families from a financial standpoint here in the States and help them navigate every decision they make, the structuring of their businesses, and being as tax savvy as possible.
For this conversation, we're going to be focusing on real estate because this is a real estate channel, a real estate podcast, and really what I do is all real estate.
Right.
Eat, live, and breathe real estate. Obviously, there's a lot of different ways that you could structure investing in real estate in South Florida, whether you're a foreign national or you're a US citizen.
Right.
So we're going to talk like depreciation, cost segregation, 1031 exchange, FIRPTA, all of this. So getting right into it, I guess the first thing I want to get into is an investor buying under their personal name as opposed to an LLC, a trust, a business. Why should they be investing in a business or buying under a business?
Essentially, let's do the easy one first. So if you're a domestic US person, always easier to just invest in a real estate property under an LLC. You remove liability.
As a US citizen.
As a US citizen. Just rule of thumb, one property, one LLC. Once you start putting a bunch of properties under an LLC, something happens within one of those properties, lawsuit, whatever it is, it opens up.
Because if you own like 10 properties, and like let's say property 1, 2, 3 wants to sue you for something that happens, now they could go after you.
Yeah, anything under that structure.
Correct.
So from a liability standpoint, rule of thumb for your US person, always best to have one property, one LLC. From a foreign person standpoint, foreign investor standpoint, that's where there's a lot more noise. So if you invest under your personal name, it might be easy to open a Florida LLC, Florida business. However, when you go to sell, there's a thing called FIRPTA withholding. There's a lot more noise being a foreign international investor. The good news is that there's structuring to protect yourself against that.
So this, so it's more for legal protection than it is tax strategy for the US domestic citizen, and then for the foreign national, it's the same, but when you go to sell for FIRPTA is when it becomes a tax strategy.
Right.
But like, really it's just for legal protection.
Legal protection, just kind of separating person and entity, right?
Right.
Having the entity own a property rather than individual person.
One of my most talked about in my world of like investor friends and clients is cost segregation. Not many people know about cost segregation. So tell me exactly how cost segregation works. Let's start with a US citizen.
So cost segregation is essentially a study from a cost segregation group, typically made up of an engineer with his team.
Yeah, and my guys were in California.
Right. So they come in and depending on the team, most of them fly in and they do a survey on the property and they identify components of that property that have a useful life of 20 years or less.
Okay.
So you invest in a normal property, say at this point we're investing in a property. There's a thing called depreciation.
Yeah.
So if it's a rental property, investment property, whatever it is, over time it's depreciating.
Yeah, and this used to only be for commercial properties, right? And then I think Trump at some point in 2016, 2017 made it eligible for residential.
So it ended up kind of opening it up for residential as well. However, it's just magnifying the depreciation benefit that you take on an annual basis.
Yeah.
So say you have $1 million property and it's a residential, the accounting rule is that you can depreciate over time, over 27 and a half years,
right?
27 and a half years, a depreciation expense by that $1 million. So it's roughly like 36,000, which is a paper loss. That's why depreciation is awesome, because it's a paper loss. It's not like property taxes that you're living Key Biscayne paying $50,000 in property taxes that you're actually having to dish that out, right?
Right.
So depreciation is an investor, especially a real estate investor's best friend. Now with this cost segregation strategy, it's just magnifying that benefit. So the engineering team would come in, identify these components of the property that have a useful life of 20 years or less. Refrigerators, ceiling fans, stuff like that.
Everything.
Just the bones of the house.
Yeah, the structure.
Keep it like that. Keep it simple. 25 to 30% is the rule of thumb that they give you as an estimate before they do it, right?
Okay.
So you buy $1 million property, now you have a $250,000 cost component total that can qualify for the useful life of 20 years or less. Now, if that property is placed in service after January 15th, you can take 100% benefit of that total amount.
In year one.
In year one.
Instead of dragging it through 27 years.
Right. So it would be $250,000 in depreciation expense year one versus if you're depreciating it over the normal period of 27 years.
So that $250,000 is essentially a loss in your taxes for that year.
Right, it's deductible, right? Like you can always have a property renting out for more than 250 grand, right, in income.
Right.
However, it's deductible, just net out that income.
Yeah.
If most of these properties, if they rent around say 60 grand, 80 grand a year, you're dealing with a decent property, that's a significant amount that you can kind of net out, right? So 80 grand in rental income, minus the 250 depreciation expense.
Yeah.
And that's not counting HOA, insurance, and all the other expenses. So.
And this is both U.S. citizens and foreign nationals could do this?
U.S. Citizens, it's a lot more easy. So you invest in a property under an LLC, and you have those losses from that rental property flow through your domestic return. From a foreign perspective, you can definitely do it, but it's preferred that you do it under a specific structure to protect you for some of the other things we're going to talk about in a little bit. But the benefits limited, because if you're structured under a corporation, the rental property, corporations are taxed at a 21% tax rate. So say you're a high income earner as a US person and you're getting taxed at 37%, the highest tax bracket. Essentially, just high level, the $250,000 depreciation expense, 37% of that is essentially your tax savings, right? From a corporate perspective, it'll only be 21%.
21%.
Right.
So it's a little bit less.
Right.
But it's still pretty nice.
But it's worthwhile. It's worthwhile.
It's still worthwhile. And when does it make sense for someone to do cost seg and for someone not to do a cost segregation?
Right. If it's a short-term investor, meaning that you're looking to
like 3 to 5 year exit.
Yeah, 3 to 5 year exit. If you're a developer, we have developers that do it just because they're ultra aggressive to get more tax savings today. But
free up cash.
Right, free up cash, liquidity. However, if you're a long-term investor, it makes all the sense in the world to do it, because if you're looking to hold properties for 30, 40 years, have your kids inherited it, listen, it's a no-brainer. Especially, we were talking about it before, money today is worth more than money in 5 or 10 years. So the tax
with
savings,
inflation.
Oh my God, the tax savings you can create using the cost segregation.
Yeah, and then you could use that extra liquidity to invest in another property.
That's what we advise everyone to do. Whenever you get the tax savings, listen,
go buy another property.
It might be nice to keep it, but if you're thinking long-term, zooming out, it's always best to reinvest those savings back into another property.
Yeah, so if it's a long-term, it's definitely worth doing it, a cost segregation.
Right.
If you're thinking about 3 to 5 year hold, maybe
weigh the pros and cons.
Yeah, maybe it's not worth it. I mean, maybe it is, but I think every situation is different. But if you're not sure if you're gonna hold it long term, you gotta really look into it a little bit more. Reconsider if you're gonna do the cost segregation.
Right.
Let's jump into foreign nationals.
Right.
The big thing with foreign nationals is when they buy, some of them don't even know when they're buying.
Right.
That when they buy, you enjoy it, you rent it, whatever you do with it, amazing. It was a great time. 5 years later, 10 years later, they want to sell. They sell the property and then they have to do something that's called FIRPTA. 15% of the sales value, correct me if I'm wrong, is withheld with the IRS, and then either it's paid because that's what they owe in capital gains, or it could be deducted and they could get some returns, or all of it. How does it work? And then how can foreign nationals
avoid it? Yeah. Foreign nationals, if you are a foreign person, meaning non-US, and you own a property directly in the US, you essentially, when you go to sell that property, the buyer that you're selling it to has to do a 15% withholding of the total sale price.
A lot of people get confused. It's the buyer, and the buyer holds it. Attorney has to do it.
Right. So then the 15% is withheld by the buyer. So you sell a property, $1 million. $150,000 has to be withheld.
Right.
On behalf of the seller, being a foreign person.
And this is regardless whether they've made money in the property, they've lost money.
It's face value. So if the property is $1 million,
50% off of sales price.
So then the problem we run into a lot of people that had improper structures and were affected by this is that now you have to go, say you didn't owe taxes, say you didn't have capital gain, and you actually sold the property at a loss or whatever. You have to go now and try to claim this money back, get it back.
From the IRS.
So for whatever reason, it's taking a significant amount of time to get that money
back. It's a headache, and
it's a headache. It's additional form, additional filing, etc. But essentially,
and do CPAs like yourselves help clients claim it, or is that like an attorney that's helping them?
Yeah. Fortunately,
You guys do
unfortunately, we have to. We end up calling the IRS on behalf of the client because people are foreign, living in Colombia.
They don't know
South
who to
America.
call, and
right. So we're quite frankly their financial representation here,
right.
From an investing standpoint, in regards to everything. So then we have to pick up the phone, call. I've had one client, they sold a property in 2019, and we've called, I don't know how many times, 4, 5, 6 times. The IRS will say, hey, okay, we're sending a check. Check never shows up. For whatever reason, it can get clunky. I mean, these governments, clunky operation, but for whatever reason, the FIRPTA withholdings, or to get that money back is a pain. So
how does someone structure their investment to offset some of that 15%?
Right. So to avoid it entirely,
because there's a lot of write-offs, right, that you could do
in terms of,
like, let's say you improve the property.
Right.
Let's say you buy furniture and the property is still furnished. These kind of things. Can you write these off when you're selling to the FIRPTA with 15% or no?
Not necessarily. I think that type of stuff will flow through with the tax return, which determines whether or not you have a tax amount due.
Okay. So it's all commingled.
It all ends up being connected in some way. The proper structure that we always recommend clients to have is do not own it in your name whatsoever.
Personal name.
What you would do is open a foreign entity, some sort of holding company. Typically in the islands, we do a lot of British Virgin Islands entities. And then also there's some clients that I know have Panama entities. That entity itself owns a US corp directly. That US corp then owns US property. And within that structure, when you go to sell it, whatever, you're completely avoiding FIRPTA withholding. Completely avoiding FIRPTA withholding. And then from an estate tax perspective too, you have protection. So say you are a foreign person, South American, Brazilian, Colombian, you own a US property directly, you are opening yourself up now to, if you were to die someday, or when you were to die, you can be taxed up to 40% estate tax on the value of that property.
Right.
So
you can still own it at the time of your passing.
Right, at the time of your passing. So with that structure, the foreign entity, whether in the BVI, one of the islands, Panama, owns US Corp, the US Corp owns US property. Within that structure, you're optimizing your kind of position in terms of from a FIRPTA exposure perspective, and then also estate tax perspective.
Wow, so with that structure, they could completely circumvent FIRPTA.
There's some cases I've seen that foreign person owned a significant amount in real estate property here in their name, and
it could be a lot of money.
The estate tax exposure, that's the biggest part too, is the estate, because FIRPTA, at some point you're gonna get it back, right? But from the estate tax perspective, if you're talking portfolios that are worth
50 million, 100 million.
I mean, do the math, right?
Yeah.
So that's why it's always best to consult.
Can someone buy under their name and then change ownership to the correct structure? Like, let's say they're like, oh, I'm just watching this video now and now I want to.
Right.
Can they change it? I'm sure they can, right?
Right. So there's ways to restructure it. There's some more analysis in terms from an accounting standpoint of their basis and a lot of other technical stuff to see what the impact would be if there's any. However, yes, there's a way to restructure if you're catching on late to actually, get into a favorable position.
And more of a basic entry-level question is, how are foreigners taxed just like on rental properties, period?
Right, so then they have the 30% withholding as a foreign person. So on the gross rental income.
Oh wow, 30%.
So, yeah. So it's a pretty big withholding. So that's why it's always best, again, to consult with somebody. Sometimes at a sale, I'm sure as you know, you want to close that property, and
if it's owned like under a proper corporation or whatever it is, you could probably now write off a lot of like travel and
right. So a lot of our
property management.
A lot of our clients come to Miami to come see the property.
Vacation.
Some of them do.
Well, work trip.
Right. So some of them it's personal use. So sometimes they buy a property and it's strictly for personal use.
Yeah.
Or it's not rented at all, and you write off the essential things of the home. So HOA.
Property tax,
insurance, property tax,
property management.
So all that stuff is write off, but then the other stuff that isn't utilities and the stuff that isn't essential to keep ownership of the property, right?
So that they cannot write off the utilities.
If the property is rented and all that stuff, yeah, you can write off anything related to the property. It's related to the business use of the property. But if it's not rented in the entire year, you're only limited to HOA property taxes and the things essential to maintain the ownership,
Got
right?
it.
Because if you don't pay property taxes,
Yeah, you
lien,
could,
all that
exactly.
stuff, HOA, they kick you out.
Yeah.
Anything essential to hold the property is deductible if you don't rent it. Now, if you rent it, you're pretty much free reign in terms of what you can write off.
The next topic, which I want to get into, which is 1031 exchange.
So 1031 exchange is essentially for a business use asset, business use property, investment
property. Cannot be personal use.
Cannot be personal use. It's essentially, you can sell a property and defer the capital gains of that sale if there's capital gains.
And capital gains typically is 15%. Could be
Yep.
more if you're high income, right?
Yep.
So typically it's 15%.
So you, if you reinvest the total proceeds of that property sale into another property, business use, investment use, you reinvest the total proceeds, you can defer all those taxes.
Kind of kick the can down the road.
Exactly, that's exactly the way to describe it. We kick the can down the road, and when you go to sell a property, you have to make the decision again.
Right, but it has to be like equal or greater than, right?
No, you can actually do portions of it, but everyone's
then you have to pay the taxes.
Right,
yeah.
So that's the
yeah, you could do it, let's say I sell my property for $1 million, I'm doing a 1031 exchange, and I buy something for $800,000.
$200,000.
So the $200,000 delta is what I have to pay.
Whatever the gain is in there.
Right,
yeah.
right.
So,
which will still be smaller, so it still helps, but.
Right.
Yeah,
So,
it's actually very...
So then there's also the bubble of you sell a property, and as of the sale date, you have to have a property identified within 45 days.
Yeah, so there's time frames and deadlines that are like super important in 1031 exchanges. Well, first of all, before you close on your sale, you have to already apply for the 1031. You have to disclose, I'm doing a 1031. You never receive that money, right? It's held by a third party. And then I think it's 45 days post-closing, you have to identify.
On paper, something that, hey, we have a property identified, and then that property has to be closed on
within 6 months,
within 180 days of the sale date.
So you have to have like your ducks in a row. You have to be like pretty aggressive, ready to go. What happens? I think the answer is nothing. But what happens if I'm doing a 1031? I'm planning on selling my property. I want to do a 1031, but I don't find the right property to do the 1031. I just have to pay taxes then. That's it.
Yeah, essentially.
But there's no like penalty, right?
No, I don't believe so. Typically there's 1031 teams, like you can hire a 1031 firm that does it. So there's some technicalities there that there's a little bit of noise. But yeah, I would imagine that it's a practical result in terms of like.
Yeah, it's like didn't work out. Now I just got to pay my, I'm past the deadline.
Right.
Okay. But yeah, if you're gonna do a 1031, typically it's not with like your attorney or CPA. It's with a 1031 company. That's what they specialize in.
Right. They help you identify the property, all the documentation, all that. So.
And it can be done so Foreign National could do it too.
Foreign National could do it too. Again, under the proper structure with the corporation, you have the corporation do the whole 1031 and reinvest the money.
What would be the biggest mistakes that people make by investing in properties? Or maybe like overlooking something? Is it coming down to really that structure that you mentioned?
From a foreign national perspective, yes. I think just in general, I think a lot of people always want to put a lot of money down to have a smaller mortgage interest amount.
Yeah, most of my foreign nationals, most of them buy cash.
Right.
And if they don't buy cash, they're putting like 50% down.
I think mortgage interest is highly overlooked. I mean, a lot of people, I have my feelings about
being
over-levered. Right, so mortgage interest is deductible. I think that's something that a lot of people overlook. I think also the Augusta Rule.
What's this?
From a business owner standpoint, if you are operating any sort of business, car wash, you have a family car wash business, and you guys do annual meetings at your personal residence, and it's family business, and you say, hey, we're gonna have
a board meeting or
we're gonna have a board
meeting
meeting on paper, we're
quarterly
doing this
meeting.
and that. Exactly. You have meeting minutes saying what you guys spoke about the business. You can essentially rent out your personal home up to 14 days at the market rate to your business. So say you live in an area that has high rates for rental, whatever, Coconut Grove, Coral Gables, the rental property, that home can rent at a market rate of 30 grand a month.
Right.
So now essentially over 30 days, each day it's worth $1,000.
Right, prorated.
So the business can rent to you tax-free, $1,000 a day. Say you make the 14 days max a year.
Yeah.
You can get $14,000 out of your business tax-free. So that's something else.
So many little, I've never heard of that in my life.
It's a wrinkle, yeah.
So many little wrinkles and like little strategies. And so that's foreign national. Anything on like the domestic US citizen that is like super important. I mean, cost segregation, I think it's the coolest thing in
Right.
terms of like saving.
Most impactful.
It's the most
100%.
impactful,
right now.
right?
It's the most impactful thing. It's I think I said earlier. It's the sexy thing right now.
Right.
That moves the needle like tremendously.
I mean,
So,
yeah, someone could go from having to pay taxes, I mean,
yeah.
hundreds of thousands less.
We've had a real estate professional that is high income earner from a real
Right.
estate fund that did a cost segregation, and he saved significant amount. I'm talking over $200,000 in taxes that he got in a refund. He's a W-2 employee, had been having the withholdings on a weekly basis or bi-weekly basis, and at the end of the year, he had a cost segregation. We reported it, blah blah blah.
If there's a high income earner that's a 1099, and obviously 1099s, you could have a really good year, you could have a slower year.
Right.
You know, like in my business, as realtors, some years we have huge years, some years it's a little bit slower, some years it's moderate.
Mm-hmm.
Is it better to do it on a high income year or low income or moderate? I mean, I would think it's not better to do it on a high income year, or it doesn't matter.
I don't think it necessarily matters
The cost segregation,
because
I mean.
the loss would flow through to your personal tax return, and if you have excess, you would essentially have that loss sitting there waiting to be netted out with income. So essentially,
You could get a check back from the IRS
Right.
if you have enough loss, right?
if your loss nets out your entire income and you've been paying withholdings throughout the year, you should expect a significant refund at the end of the year.
So yeah, it just depends, I guess, on your personal. But I think the cost segregation in general, it's the most advantage you get is when you do it year one, right?
Year one
Of service.
of placed in service day. Yep.
So and by year one of service is when you put it for rent.
So when you place it for rent, right? So you can buy it,
Well, you could live in it for 5 years.
and the placed in service date would be
When you move out and
when you move out, and you
have a tenant move in.
right.
And they're paying you rent, there's a lease and all that.
And it's listed for rent. When it's listed for rent is the date that it's
That's when it
technically
starts.
placed in service.
Wow.
Right.
So, okay, so cost segregation is for sure number one, like most impactful. I think what you mentioned, especially for foreign nationals, the proper structure. I mean, I didn't even know that you could completely
Right.
avoid FIRPTA,
Yeah.
which is crazy to me, but it's awesome, it's amazing.
Yeah.
So that's pretty huge too, actually, especially for foreign nationals.
Yeah.
U.S. citizens doesn't apply. All right, I think we've touched most of what I wanted to touch on today.
Right.
Is there anything else that you would say from your professional view that is important to touch on?
Yeah, I think you brought it up now at the end, especially in a market like Miami, being an international market. I think it's imperative that a real estate professional kind of knows about this.
Yeah.
And it's not only beneficial for obviously the buyer and the seller, but from a career perspective, you could build a tremendous reputation and trust with the client and all that.
If you're helping your clients save money,
Listen,
they're gonna trust you
Right.
and want to work with you down the road.
Right, and they're gonna.
But it's a tricky line, right? Because me as a real estate professional, I could talk about real estate comparable to market all day long, but I never want to give the tax advice.
Right.
I'm not licensed to do it.
Of course.
I don't want to say the wrong thing.
Yeah.
So that's when I get the phone and I connect them to you and I let you guys talk it out. Because again, legal advice, tax advice, I stay away. I know the high level.
Yeah.
The high level
Yeah.
stuff, exactly.
Yeah.
Cool. Well, I think that's really everything that we wanted to get into. So, Alex,
Appreciate it, brother.
thanks for coming in. And as always, thanks for watching. If you have any questions or want to connect with Alex, his information will be in the notes. And we'll see you next time.